What's going on, everybody? In today's video, I want to talk about the S&P 500. And recently, I've seen comments from big investors saying how they're bearish on the S&P 500. I've seen a lot of news headlines potentially freaking people out that maybe the S&P 500 is not the right buy right now because it's way heavy into tech. And for years, the S&P 500 has kind of been treated like the default investment for most beginner, intermediate, and advanced investors. And whenever someone asks me, what should I invest my money in? The pretty much common answer that I'm going to tell everyone, and a lot of people are going to say, is just buy the S&P 500. And honestly, for most people, it's kind of like the gold standard of financial advice, financial investing. It's simple, it's pretty diversified. We'll talk about that in this video. It's low maintenance, and historically, it has been one of the easiest ways for regular people like you and I to build wealth over time. However, there is one thing that a lot of investors need to realize, and maybe beginner investors don't necessarily understand this, but when you buy the S&P 500, you're not buying 500 companies equally. You're buying an index that is weighted by size. That means the biggest companies have the biggest impact on your future returns. And right now, it's no secret that a huge portion of the S&P 500 is tied to massive tech companies. Companies like Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet, which is Google. So the natural question that a lot of people have is, should I be worried that the S&P 500 is so concentrated into the tech sector right now? And in my opinion, the answer is not really a simple yes or no. It really depends on your future outlook with investing because, tech concentration can be a good thing. It could potentially be a bad thing. And I want to talk about that in this video. So let's go ahead and let's break down what the S&P 500 actually is. And if you've been investing for a little bit, this might be common knowledge, but to any new investors and beginners out there, you got to start with the basics first. And a lot of people hear S&P 500 and they might assume their money is spread evenly across 500 companies, and that's quote unquote true diversification. But that's not really how it works, right? The S&P 500 is market cap weighted. So in simple terms, the bigger the company, the bigger the position within that index. So the S&P's own methodology says that US indices are weighted by float adjusted market capitalization. So for example, if Nvidia, Microsoft, Apple, or Amazon becomes one of the largest companies in the world, it organically and naturally will become one of the biggest parts of that S&P 500 index. That's why the S&P 500 can technically hold 500 companies, but still be heavily influenced by the top 10, or you might have heard of the Mag 7, the Magnificent 7. And this is really important to understand because when people say they're diversified because they own the S&P 500, while yes, they are diversified, it's not equally diversified. So you're still going to own healthcare, financial, industrial, consumer staples, energy, utilities, and other sectors, but the biggest companies are doing a lot of the heavy lifting when it comes to your returns. And that's, once again, that's not automatically bad. It's just something investors need to understand because if you own VOO or SPY or IVV, you probably have more exposure to mega cap tech than you might actually think. So you might be asking yourself, well, why has tech become so big? And the reason tech has become such a massive part of the S&P 500 is pretty simple. These companies have been extremely dominant for a decent amount of time now, right? They have huge profits, they have strong balance sheets, they have global reach, massive user bases, and business models that can scale extremely well over time. Microsoft, if you work a corporate job or any job, Microsoft is everywhere in business. Apple has one of the strongest consumer ecosystems in the world. Nvidia was probably the backbone of the AI boom. Amazon just absolutely dominates e-commerce and cloud computing and so forth. So these are some of the most powerful businesses in the world. So in one way, the S&P 500 being tech heavy does make complete sense. The index is basically saying these are the companies that the market currently values the most. And if those companies keep growing earnings, building new products, leading in major trends like AI, cloud computing, semiconductors, etc., then having exposure to them can be a very good thing, especially while you're young. And that's why we see, this S&P index kind of pumping so much with the market. The issue is understanding what happens when one sector becomes this important to the overall market. So one thing people might wonder is, has this ever happened before? And this is where the history of the S&P 500 really matters because, the S&P leaning heavily toward one sector is not necessarily a new thing. right? The index has always changed based on which companies and industries are dominating the economy at that certain time. That's literally how it works. And when one sector gets bigger, more profitable, and more valuable, it's going to naturally become a larger part of the index. So today, as we see it, that sector is technology. In the past, it has been other areas, whether it's energy, financial, industrial, whatever it might be. The S&P 500 is not frozen in time. It evolves as the economy evolves. And I would say the most obvious comparison to today is in the late 1990s and early 2000s during the dot-com bubble. Back then, technology had become a huge part of investor excitement. Everyone wanted exposure to the internet. Money flooded into these tech companies. Valuations went through the roof, and eventually the market had to reset. And S&P Global had noted that information technology at that time made up around 33.6% of the S&P 500 in August of 2000, which was the last time tech concentration looked similar to recent levels. And when that bubble kind of bursted, it was pretty upsetting for a lot of investors, right? The Nasdaq got crushed, but even the S&P 500 suffered because tech had become such a major part of the market, right? Yahoo Finance reported that after the S&P 500 peaked in March 2000, it dropped about 24.8% over the next 2 years, while the tech-heavy Nasdaq fell around 62.7%. And that is the risk of concentration into one sector. And when one sector carries the market all the way up, well, on the flip side, it can also drag the market completely down. Now, does that mean today is exactly like the dot-com bubble? No, of course not. I do think that comparison gets a little overused, and a lot of today's biggest tech companies are much stronger than many of the dot-com companies were. And right now you might hear kind of like the AI bubble. Because while the S&P 500 is diversified, it is definitely not immune from concentration risk into these sectors, specifically around AI. All right, so now let's talk about the good side and the bad side of having a tech-heavy S&P 500. The good side should be pretty obvious. Tech has been performing like crazy recently, and when the S&P 500 is heavily weighted towards tech, if you own a simple, S&P 500 index fund, more than likely your portfolio is in the green right now and you have benefited from that, and you didn't have to pick any single stocks, you didn't have to time AI, you didn't have to time this and that earnings report, nothing. You own the index, winners become bigger, you have exposure to them, therefore your portfolio goes up. So the good side is this. Tech concentration means you have exposure to some of the strongest companies in the world without really doing anything. So there's your win. Now let's look at the bad side of having a tech-heavy S&P 500 because there's also a downside. The more concentrated the S&P 500 becomes in this small group of companies, the more your returns depend on those companies continuing to perform. And if the biggest tech names keep winning, obviously the index is going to continue to be on a roll and do great. But if those same companies slow down, get overvalued, miss earnings reports, face regulations, disappoint investors, literally whatever it might be, the entire index can and probably will feel it. And that's the risk. And so you may think you're buying this really broad diversification, but a huge part of your portfolio is pretty much tied to the same themes. AI, cloud computing, semiconductors, digital advertising, software, consumer tech, etc. And if those struggle, well, your portfolio is probably going to be red for a little bit. Now, once again, that does not mean the S&P 500 is bad. That just means you need to be aware of what you're actually holding. So is the S&P 500 being tech heavy actually a problem? So I'm going to give you guys my opinion here. I think the answer is it really depends on how you're using it. And I know that's the boring answer, but hear me out. If you're a long-term investor, you're young, you're in your 20s, you're in your 30s, and you're buying consistently for decades, this is not something to worry about. It's not something to care about. You have 20, 30, 40 years in front of you of good investing, money compounding. Put your money in the market, be consistent, let it do its thing over time. The S&P 500 is going to consistently change, and your goal is just to consistently invest. Now, on the flip side, the only time I think you really should not necessarily worry, but you should care about it or pay a little bit more attention is if you're close to liquidating some of your assets. So if you're close to retirement age or for any reason, you're going to use this money soon for a big purchase or whatever it might be. At this rate, I would potentially look at moving some of my money out of the S&P 500 and into something a lot more stable. Now, do I think the S&P 500 is a bad investment? Absolutely not. But with it being this heavy on tech, there is days where we could see a 3% shift, a 5% shift, maybe worst case scenario, a 10% shift. And if you have a $2 million, $3 million, $4 million retirement portfolio, the last thing I would want to do is lose 5% of that. So at that point, I would really work on moving my money towards something way less heavy in tech and more something that's going to really protect your money over time. And I think overall, the worst thing that we can do as investors with this type of information is put off investing. And I know it might sound like a broken record here, but the fact that, these news headlines come up and there's, multi-billionaire, millionaire investors going on the internet saying, "Oh, I'm bearish of the S&P 500. Everyone needs to worry about it." It is such ridiculous stuff to put out there because you have young, impressionable people who are starting to worry about investing, starting to look into investing, and they see headlines like that and they continue to push investing off because they're worried about the tech sector being so heavy. Once again, like I mentioned prior, if you are under the age of 30, you should get your money into the S&P 500. Let it start working for you. Let it start compounding over time, and really don't care about what sector it is leaning towards at the moment because it's always going to change and you have so much time in front of you to ride out that change. So at the end of the day, the S&P 500 is tech heavy for a reason. The biggest tech companies have produced massive profits and carried a lot of those market returns. And this is the good side because if you've owned the S&P 500 recently, like I said earlier, more than likely you're in the green. Now, the bad side is that investors may be taking on a little bit more concentration risk than they actually realize. That does not mean that today is exactly like the dot-com bubble. It does not mean the S&P 500 is bad. It doesn't mean you should stop and wait for investing. It just means you should think of the S&P 500 for what it actually is. It is market cap weighted, and the biggest winners are going to become the biggest positions. And that will help you on the way up, but it can hurt you on the way down. So don't panic, don't keep your money out of the market. Get it going, let the compounding do its thing. Just completely understand that while you are quote unquote diversified, there is days where you could see a 3% drop, a 5% drop, or worst case, a 10 to 20% drop just because it's so heavily weighted towards tech. So all in all, you just need to understand what you own and be confident in your portfolio. And in my opinion, the S&P 500 will always be the gold standard because you don't have to worry about finding the perfect fund, right? It's just building a portfolio that you can stick with when the market stops making everyone feel like a genius. And if those times come soon, I'll still be fully confidently investing into the S&P 500. So as always, thank you guys for watching this video. Let me know what your thoughts are on the S&P 500 in the comments down below, and I'll catch you guys in the next one. See ya.